Welcome back to the How's the Market podcast. This week we've got Lance Lambert on. Lance is the former writer at Fortune Magazine's focused on housing and brings a very, very unique perspective. He's a consultant. He's launched ResiClub. He's doing so many things right now, helping people, helping consumers understand the housing market. And we've got him on the podcast to talk about several things that are, hot topics today. First, we're going to dive deeper into institutional investors and their activity in the market. A lot of buzz about that right now. The second thing, we're going to talk about affordability. Lance has a unique perspective on the past decade, what caused the affordability advantages we saw in this country, and what affordability looks like into the future. And third, one of the areas he is an expert on, the builders in this country, what they're up to, how they're winning in this market, and what he sees ahead for them. So let's go ahead and let's jump in. Well, Lance, I'm excited to have you on the podcast today. Thanks for making time to join.
Yeah, so excited to be here. A big fan of your guys' work and the stuff that you do and your team does. You do a really good job of helping people to understand the U.S. housing market. So really appreciate it.
Well, thank you for that. The KCM crew does an amazing job of putting all of that together. All the work that we do is in thanks to everybody that's writing, researching, helping members use it more effectively. And so I agree. We've got a team that is dedicated really to helping folks understand things. And that's one reason that I wanted to have you on the podcast. You've always been somebody that has wanted to help people understand, the housing market. You've written extensively, as a writer for Fortune. You now have ResiClub. You do work with corporate clients, I know, that leverage all the work that you do. Tell folks that maybe don't know you, Lance, a little bit of your background. What got you started really in this in the housing market?
Yeah, what got me started is I was working as a data journalist at Bloomberg, and I had decided I was going to leave journalism. And I wanted to become a data scientist, was taking a lot of courses for it. And so I kind of took a bridge job out of journalism, which was working at realtor.com and analyzing their data. And I thought because I would be working so close with their analyst and their data scientist, that would be a good bridge for me out of journalism. And while I was there, my 2 years at realtor.com, 2017, 18, and 19, I was looking at regional housing market data every day. And So what occurred is I decided I wanted to stay in journalism. And I left realtor.com to go work at Fortune, where I went there not to cover real estate, but was actually building a data newsletter for executives and CEOs. But while I was there, the pandemic occurred. And my wife and I, we decided we were going to move back to Cincinnati, where we were from, build a house. And at the same time, the pandemic housing boom took off, right? And so there was a big need for people to find information about housing. And so I got sucked back into writing about housing because I knew so much about the regional data.
Right.
And that stuff. And from there, I really just got interested in it and interested in what was happening in housing and interested in just helping people find out good information, because there is no shortage of bad information on housing.
Right.
You can find as much nonsense that you would like. And the thing is, people aren't even searching for a lot of the nonsense. It just kind of comes to them. So an example of that this week, or last week, or recently, somebody tweeted out that 42 or 44%.
44. Yeah.
Yes. They said that 44% of all the homes bought this year were bought by private equity firms. That's a number that is not, 2 times bigger. It's not 3 times bigger than reality. It's not 4 times. It's at least 100 times bigger than what has happened this year. And even if you would take a broader approach and not just do private equity, but all institutional buyers, any buyer that has at least 1,000 homes in their portfolio, they only bought 0.44, and I'm talking about a half of 1%, so one out of like 200 and something homes this year in the U.S. housing market, according to the latest numbers by John Burns Real Estate and Consulting. And according to Parcel Labs, they own 0.73, so still less than 1% of the total U.S. housing stock. And even if you allow yourself to look at maybe companies with at least 100 homes in their portfolio or at least 10 homes in their portfolio, it's still, you can only get that number around 3%. So the really big players, while they're out there and they are bigger in places like Charlotte, Jacksonville, Atlanta, Phoenix, Dallas, Houston, on a national level, they're just not as big as people think. And and numbers like 44%, it's just completely made up. And the source for that was an obscure Medium post where they cited a Business Insider article and an Atlantic article. So I'd actually subscribe to those places just to make sure and verify where they got it from. And it wasn't even mentioned in the story. So
interesting.
So the Medium post came up with a fake number, cited places. The places they cited didn't even have the numbers. And then just, some MMA fighter with 500,000 followers tweeted it out. And then the next thing you know, several people were tweeting it out. Elon comments on something about it. And pretty soon that number is going to be something that, gets cited and, just without people knowing where it came from. And it's going to be floating around the universe for a while.
Yeah, it's amazing to look at that and say, okay, maybe even to try to draw, this is where it came from, but to look somewhere and say there's no even misinterpretation of something just to see that. So why do you think, you said something before that there's so shortage of misinformation on the housing market. Why is that the case?
I think it's for a few reasons. One being that we lived through a historical anomaly, which was the great financial crisis, right? Mm-hmm. And home prices on a national level dropping like 27%, some markets going down 50%. It was a very steep recession that came with it. It created a lot of economic, political, socioeconomic issues in the country. And it was also a very big historical anomaly. And so I think a lot of people think that because we've lived through that it will happen again. And so I think people are always kind of seeing ghosts in a way. And so when somebody writes something that kind of invokes that, because people lived through it and it has an emotional impression on their lives, because although maybe they didn't get hit by the housing side of it, they might have gotten hit by another side of it. And so it just hits an emotional element in people. And so I think having lived through that is what's created a lot of the misinformation that is constantly pushing a very big national housing crash. And I think if you look at the historical data, one thing that's really interesting is that you go back the entire post-World War II era, and there is only one national crash for prices, and that's GFC. Now, there's some other ones where there's some regional corrections that were, steeper. There was the mid-'80s, late '80s oil and bust in Texas, and prices there dropped a lot. In the early '90s, there's parts of California that get hit. And so there's always been regional corrections. But on a national level, GFC and the housing bubble, housing crash is just an anomaly.
Yeah. Your perspective on that, and I've always thought too, we've said at KCM, when people hear the word recession today, they immediately tie it back to the great financial crisis and, maybe seeing somebody, a family member, go through, a challenging situation in their home, have to get foreclosed on, whatever the case is, and they associate that to whatever could come today. But there's no doubt, I'll tell you an interesting thing. We published in the last couple of weeks, we published a social post on institutional investors and who owns homes in this country. And we just yesterday or the day before, at the time we're recording this, published an Instagram post that the 30-year fixed had fallen below 7%. Tremendous news, right, for anybody looking to buy a home. Guess which one got more activity? The institutional investor post.
Really interesting.
Then even on that, it's amazing to see the number of people that their ears are up. So if somebody's trying to understand that, can you give a little bit of perspective on when Wall Street started to participate in our business? Because I think it's in this subject, it's about being educated and certainly bringing the facts, because there's just information out there that people maybe want to vilify somebody in this country, relative to housing.
Yeah. So what occurred is that following the housing crash, there was a lot of homes in a lot of parts of the country where inventory was high, prices were still falling, there wasn't really a bottom, and they had fallen just too far beyond fundamentals. One thing about the housing crash is that, yes, there was a crash, but then there was also an overcorrection too, where prices went too far down. And so the institutional buyers saw an opportunity, because what had also occurred is there was a tightening of mortgage standards, which was also hitting the market, and it was kind of trying to figure it out. And so because prices were so low and were overcorrecting and it went too low, it created an opportunity for the institutional investors to jump in, chase the yields, knowing that then prices would probably move. They would have a good rental yield. And so a lot of the homes even owned today, a lot of them were bought back then,
right,
during that very low period. And they, according to some papers, helped to put in like a bottom into some of these housing markets.
Right. And let's also draw the difference between the way those homes were acquired back then is very different than today, right? They'd come in and acquire, a portfolio of homes, and even with banks, you know what I mean, to go in and say, hey, we're gonna take all these assets off your books. Very different than how that's going today.
Yeah, so the game has definitely changed now, where then they were just buying up a lot of homes in these markets that had fallen too far. Think like Las Vegas and Phoenix, where corrections were like 55%.
Yeah.
Now, a lot of what's happening is build to rent, where these builders are teaming up with or these institutional investors are teaming up with builders to build communities, which will then be rented out. And so it's managed differently than a bunch of scattered homes. And this is one of the reasons why some economists are worried about some of these bills trying to ban institutional investors. Is on a net basis, if they're teaming up with builders to build communities, that's a net improvement in housing supply for the country. And if you completely ban the institutional investors, you could kind of drive out some of that supply. Now, it's not a huge part of the market. It's still a smaller piece, but it's something. And I think that it's, I think the best thing that could occur is for people to use this as a moment to kind of educate themselves and see what's happening in the housing market in terms of institutional investing, and not just a bunch of narrative and nonsense. And I think what they would see is that institutional investors are a small percentage of the market, although in some pockets of the country, they're a bigger share. And then what's occurring now with a lot of their buying is actually build for rent, which is a net increase in supply.
Yeah. So I think, to your point, agents, anybody in the housing market that's listening to this, loan officer, agent, title rep, that's following what's happening, can be educated, right? And we have the opportunity in today's market to take great information and say, no, this is what's actually happening. So I think the question that comes up too, that I'd love your perspective on, is kind of a two-part question. One, what do you see as the future of the institutional investor? And two, where the conspiracy theory kind of winds up on this is sort of this scenario where people say, well, wait till they get ready to dump all of these homes. Is it, I don't know if you've heard that or like what you think about the future in those scenarios.
Yeah. So where I see institutional investing right now is that during the pandemic housing boom, there was a big surge up. And for, at the height of like Q2 2022, they were buying 2.2% of all US homes that quarter. Or not in the whole country, but of the sales that quarter, they were 2.2%. Right. So still very small, but for them, that's a bigger percent than normal. And the reason that occurred is it was really a perfect storm for high returns. Home prices were moving up quickly, rents were moving up quickly, easy access to capital, low interest rates. So a lot of money was floating around, and it needed places to kind of go chase yields, and housing was one of the many assets that boomed during the pandemic. And so that's why they jumped in. What has occurred since then is interest rates have spiked, rents aren't increasing as fast, and home prices are very high, and construction cost, and this is important because a lot of these institutional investors are buying homes that are, maybe less than ideal on the market and need a lot of repairs. And if the construction costs are high, for them to flip it into a rental, then that also hurts their yields. And so we've seen the returns for buying homes as investment properties right now is come down. It's not as good of a period.
And they've sort of pulled back in that too, right?
Yes. So by pulling back, it more or less, they're not buying a ton. They're not really selling a ton on an aggregate basis. They're just kind of like sitting on the sidelines. Now, Are there a few that are selling? Yeah, like Vinebrook is selling like 3% of their portfolio. It adds up to like 500 homes on the market right now. But on a national level, when you have, several, like 4 or 5 million home sales a year, 500 homes isn't a lot.
Sure, right.
And so, maybe in some of the neighborhoods and zip codes, it matters. But on a national level, it's usually not going to have a huge impact. So I think what we're seeing right now, and what we will continue to see, is that when we go through periods where the yields make sense for these institutions, they're going to buy more. And when we go through periods where the yields don't make as much sense, they're not going to buy as much. And there's also going to be periods where, they're selling some homes, and some of these institutional investors will over leverage themselves and need to sell some homes. But at the end of the day, on the aggregate level for the U.S. housing market, it's not moving the needle a ton.
Yeah. I appreciate your breakdown. It's a hot topic for sure right now, and I think it will be going into an election cycle. It will certainly be a hot topic, right? Because it can, the institutional investor can become, and in some of the false narratives, the reason you can't buy a home right now,
Well, so that goes to one of my theories, which is I think that next year could be a little bit of a tough year, not just for the institutional side, but really across the housing industry, where housing affordability has gotten so strained. And now we're going into an election year, and people love to point the finger. And so I think what we're probably going to see is more communities and people running for local office pushing back against like short-term rentals. You have seen the national, DOJ look at National Association of Realtors. I think what they'll probably realize is that is not a good political issue. While you would upset way more people than you would, I
get you.
Yes.
Yeah.
But I think on the short-term rental side, they're the ones probably the most vulnerable to political pressure this year. Now, the institutional side, I think that could pick up. And you already saw that one bill that was put in, the quote-unquote ban hedge. I forget what the name of the bill is, but it's essentially ban hedge funds from buying homes.
Right.
And by definition, they're calling out institutional investors. I looked through the bill a little bit, and I do think the bill, which not only calls on a ban of institutional home buying, but calls on them to sell off all their homes within 10 years. I think it would also ban build to rent, which is institutional investors, teaming up with builders to build homes. So on a net supply side for the housing market, it might actually hurt things. And so I think looking ahead, if affordability stays strained, it probably will work its way a bit into politics. Now, one of the good things is that we have been through this period where affordability has gotten really strained, right? House prices went up a lot during the pandemic housing boom. Then mortgage rates went up a lot, and that really deteriorated affordability. But hopefully, now that the Fed is saying that, hey, the median member of our FOMC board thinks there's going to be 3 cuts next year, and as you see financial markets start to price in those cuts, and if yields in the bond market come down and mortgage rates come down and affordability starts to improve, people start to have a little bit of acceptance about, hey, you know what, this 3-4% mortgage rate I have, these probably aren't coming back. And maybe if, they get a mortgage rate, they buy down to like high 5s or low 6, they're like, you know what, my life's kind of moved in a different direction. Our family's gotten bigger. Let's move.
Right.
As some of that acceptance and if mortgage rates can come down a bit and affordability improves, that hopefully will also relieve some of the other like political tensions that the housing market can be facing.
Most real estate agents know what's happening. Good agents understand what's happening. But great agents, they can explain what's happening. At Keeping Current Matters, we help real estate agents become experts. With market insights and marketing tools, you'll not only stand out, you'll thrive in any market. Keeping Current Matters. Be the expert.
I want to talk about affordability. I want to go a little bit deeper with you and get your perspective on it, because this is where the institutional narrative ultimately goes to, in some ways, is affordability. And I agree with you on the fact that typically legislation and any type of political effort in housing has been demand generated on a first-time home buyer credit or grants or things like that. And in the future, near future, it'll be inventory based, right? Whether it's short-term rental or something else. How do we create more inventory? So agree 1,000% in that. When you think about affordability, is there a sort of a metric? We always like to look at NAR's Housing Affordability Index. Is there one that you look at regularly, or how do you measure affordability?
Yeah, so affordability, which, when I say housing affordability, it's a little misleading, because housing affordability on a net basis is actually really great in the U.S. because most people own their home, and most people have a mortgage that is, the net effective rate is like 3.6 to 3.8%.
Sure. They couldn't go rent an apartment for probably what their mortgage payment is.
And then you have another 35 to 40% that own their home outright. I forget what the number is, but it's pretty high. And so housing affordability on a net basis is actually fairly good. And even in the rental market, it's not too strained to historic fundamentals. The one piece of the market, though, that is very strained right now is the purchasing market. Somebody who goes out and buys a home at today's mortgage rates and today's house prices. And so the three variables there are incomes, mortgage rates, house prices. And given the run up in home prices and the mortgage rate shock, in October we hit the highest level for or the worst level for housing affordability in the purchasing market since the early 80s. And the early 80s, we had 15, 16, 17, 18% mortgage rates for a period. That's come down a little bit as mortgage rates now have fallen under 7%. And so I will sometimes use the Atlanta Fed's housing affordability metric, which goes back to 2006. But I also rely a lot on Black Knights that they put out. I think it's pretty good. It goes back to the 70s. NAR has a good one too. And No matter what you look at, affordability has gotten strained. But as mortgage rates come down, you should see some improvement there. Now, one thing to keep in mind is that the past decade heading into the pandemic, the 2010, and really you could take this all the way to the end of 2021, housing affordability had its most affordable decade ever. That was the most affordable decade ever when you factor in mortgage rates, house prices, and incomes. But if you go back and look at the articles written in that decade, it was all about millennials can't buy homes.
Right.
Millennials are never going to be able to buy homes. The majority of millennials are now homeowners, which people kind of forget. But that decade was actually a very affordable decade for housing affordability. So I think getting back to that is very unlikely, because what created that was a bust and a national crash, and then the economy, which struggled for a very long period of time and kept mortgage rates very low. That period is less likely to be repeated, and it's not something that people should necessarily be rooting for. But I think we could get somewhat closer to historic average of affordability if mortgage rates come closer to like 6.0, 5.5, then you would kind of get closer to the historic average, which is still above pre-pandemic levels. But
say that again.
So if mortgage rates fall right now to 5.5 or 6%, while the affordability levels in the purchasing market for the housing market would still be above pre-pandemic levels, they would be fairly close to the average historic norm, like the 40-year average.
Yeah. I think it's interesting because certainly when you look at affordability in the last decade, really, if we're talking 2010 to 2020, affordability has been tremendous. But you bring in a good point of realizing why that was the case and what happened to set that up and where we are today, which is very different than that. And let's be thankful for that in housing, that we don't have a repeat of the great financial crisis or the housing crisis, really. And so we shouldn't expect to see that return to this, outsized affordability, which has been very good for people over the last 10 years or 10 plus years. I think that's an interesting perspective. What do you see? I think in the future, next 10 to 20, 30 years, the narrative, sometime just like the institutional investor narrative, can be young people, Gen Z, whatever it is, will not be able to buy a home. And how do you see that playing out as compared to prior generations? And you drew it up pretty good, like to look back in 2011, 12, 13 and see some of the same, sort of articles for millennials.
Yeah. So one thing I'm pretty certain of is they will want to buy homes, and they will buy homes. There was a lot of articles coming out of like GFC about how home ownership was a bad deal. Renting is better. Millennials aren't going to buy homes. Their lifestyles are different. And what occurred is that just like with any other generation, millennials got older, more of them got married, more of them had kids, more of them wanted to buy homes. That will be repeated by Gen Z. The only question is, it's kind of an age question, which is over the past like 4 generations, people have been buying homes a little later. They're still buying homes, but the first-time home buyer is getting a little older with each generation. So it's like, when is Gen Z going to buy homes at the same age that millennials did? Or because affordability is strained and some lifestyle things are different, are they going to buy homes like a year or 2 later than millennials did? I think that's the biggest question, not if they're going to want to get into the housing market or not. I think they will. And I think a part of the reason they also will is that if you notice Gen Z content, they actually talk a lot about the housing market and about housing affordability. Yeah. And so if somebody cares that housing affordability seems kind of out of reach to them right now, or that housing affordability is kind of strained, that tells you that that's like an aspirational thing for their life and that they're thinking about it and caring about it. And so I think as their incomes grow and affordability improves and they age, they'll be buying homes like any other.
Yeah, that's a great point. That's a really good perspective. This is a great conversation. So, institutional investors to affordability, which leads me to the third topic that you do a lot of work in, and that's with builders. This is a year in wrapping up 2023 when we're recording this, that I think in the market overall, builders have figured out a way to navigate it and win and offering incentives. But what are you seeing from builders right now?
Yeah. So one thing that occurred this year is that by category in stocks, single family home builders have seen some of the biggest returns in the country, in the market. And what happened is that Wall Street pretty much came to the realization, builders are going to do well on the single family side, regardless of rates. If rates come down, so rates have gone up, and these big box builders have been able to use their high margins to offer things like mortgage rate buydowns and other incentives to kind of entice buyers into the market. And, a lot of them have mortgage arms. And so as mortgage rates went up, actually the big builders, the big box builders are getting more market share and still, building single family homes. So some people have thought, as mortgage rates come down, well, that's going to hurt builders, right? Because they can't do the mortgage rate buydowns. But at the end of the day, they'll still do well there too. So I think where we kind of are is that a lot of the country is underbuilt for single family homes. And there's just not a lot of inventory in the existing home market that's competing against these builders. And so there's demand for the homes. And as affordability gets strained, one thing that people do is they just change expectations. And so people are going to buy smaller homes. And we're seeing that. And the builders are smart, agile. They think a few years out. And, it seems like at least what the market thinks is they're well positioned for the next several years.
Sure. No, I think so. Well, I mean, depending on where you look, we're undersupplied by, you probably have really good numbers on that, 2 to 5 million homes, depending on where you look. Can builders can they make a dent in that number in the next few years? What's their strategy relative to that?
Yeah, it's kind of tough. Those estimates range a lot. It's pretty much the range you had given. They'll probably, it kind of depends on a number of factors, and also how the economy goes. Where does household formation go? But I think one thing that's worth pointing out is that in past periods, when the Fed has jacked up interest rates, they've almost always, if they've jacked them up, especially as much as we've seen over the past year and a half, it almost always leads to recession. But one of the things that also usually occurs is that as the rate hiking cycle goes on, builders take a hit and, they start to lay off workers, and completions and single family starts and all that rolls over really hard. Well, this cycle, mortgage rates went up. The builders had the highest profit margins they had ever had during the pandemic. And so they just came down a bit on margin. So did an affordability adjustment, and some places price too. But the affordability adjustment helped to buffer them from taking hits on volume and transactions.
Yeah.
And so this is a really interesting number, but if you Google residential construction employment, FRED, you will see the government data that shows that we are at the cycle high still for residential construction employment. And if you go back and you look at every recession in the past, it's already was rolling over like almost 12 months before the recession. So the builders, in a way, have not only helped to, create a little bit of an affordability improvement to keep some buying activities levels happening in the new construction market, but they're also helping potentially to soft land the whole economy.
Yeah.
And one thing that occurred is during the pandemic, you saw the supply chains get overwhelmed because there was a hit to the labor side of the economy. And then you also had this huge rush in to buy goods because people couldn't go do things. They couldn't do international travel. They couldn't do cruises. And you also saw a huge wave of pandemic migration and a housing boom, and a lot of people selling their home to go buy something new. And the point I'm getting to there is if you're buying a new home and you're selling your home to buy something new, or especially if you're moving from like New York City, San Francisco to somewhere else to get a bigger place, you need more stuff, right? And so the housing boom and the pandemic created this supply chain issue. And that is one of the reasons that inflation took off. Well, as the Fed started to jump up rates, we saw that existing home sales came way down. There was less churn in the housing market. People were buying fewer things, and they weren't buying as many cabinets, fridges, because they weren't moving. And that allowed the supply chains to ease up. And it also allowed the supply chains for new construction and builders who'd gotten really backlogged, and allowed them to begin to build homes faster and put more of the completions into the market. And so the long story I'm getting to there is the housing market itself might have helped to soft land the whole economy. For two directions. The builders not taking a big hit on volumes, and then also this drop in existing home sales. While it's bad for the industry, there's some elements to that happening that probably helped to loosen this supply chain issues.
Yeah, well, I think you put it very well, because we definitely contributed to it, right? The lead up in it. If there's help in the past year, that seems right. So where do you fit on next year, recession, soft landing? Get out your crystal ball and what do you see?
Well, I don't like to go too far in that direction. Not a macroeconomist. Do talk to a lot of them often, but I will say that my view this cycle has been that you wouldn't get really bearish on the economy until you see residential construction employment roll over, and we haven't seen that. And we've also seen inflation come down significantly, and now the Fed is kind of pulling back, and so rates are going to become less restrictive to the economy. That's going to allow some elements to the economy to warm up, hopefully the housing market. Existing home sales, probably start to move up a bit here, depending on how much rates come down, and that helps the economy. So it'll be interesting to see. But on the economy, it's just hard for me to get really bearish if I don't see residential construction employment rolling over.
Yeah.
Because I'm kind of in that view of housing is the business cycle. And really specifically, single-family construction. It's a huge piece of the economy. It's one of the pieces of the economy that contracts and grows. And so, when it's contracting, usually the economy is contracting. It's not like healthcare, which healthcare is usually pretty firm and steady, right? Residential construction moves up and down. And when it moves up, the economy is usually booming. When it moves down, the economy is usually in recession. And right now we're kind of in this middle place, kind of maybe starting to tick up even a little bit.
Yeah, it's an interesting take, and you have a great vantage point in working with builders and doing everything that you do to give that. I'm grateful for it. Are there any other? I'll wrap on this. Are there any other trends right now that you're seeing or thinking about that aren't being talked about in real estate?
Oh boy. Because I'm so active on Twitter, and usually when I have thoughts and I have things that I see that aren't getting talked about, I usually, raise them. I think some of the things that are interesting are like what's happening to home insurance, and some of the premiums, especially down south. How does that impact those markets? Interested to see how, things, where does Gen X start to retire, right? Like, what are the housing markets that are going to benefit from them retiring? Because one of the things about the boomers' retirement is that it drove up prices in a lot of markets, right? And so now those aren't necessarily as desirable for Gen X retirees once we get there, based on affordability, if we kind of stay where we are now. And so I don't really know what the answer is in terms of like, where does, this next group of retirees, the next 10, 15 years, where do they go? But I think that's a great question. And I think it's something that, the people who set themselves up for it are probably going to make a lot of money if they know the answer to it.
Yeah, it's a great point. And Lance, I just got to say, this is a fascinating conversation, fascinating to have you on and just hear your perspective on these topics. I'm super grateful. And I want to say this as we kind of wrap our time together, we've definitely got to do it again.
Yes, this was great, David. Really appreciate it.
Well, good. Well, we are so grateful for all the great work you do. We try to amplify it at KCM and get the word out there. And so thank you for that. And, more than anything, we want to get the information in people's hands where they can help buyers and sellers make a great decision. Lance, you do that, and that's what you stand for. So we're grateful for it. That was an amazing conversation with Lance. Like I said, I want to have him on again because he brings such a wealth of information to the table when we start talking about these topics. The Housing Market Podcast is designed for you. Keeping Current matters, we believe every family should feel confident when buying and selling a home. And that is our mission, to give you the information you need to be the expert for the clients you serve. So if you like this podcast, please like it, please subscribe, and share it with somebody that you know that could benefit from this information. And we'll see you again next week on How's the Market.